Hi, guys. It's Chad Larson with MLD Wealth. This is MLD Money Manners, and it's the year in review 2023 and our 2024 outlook. It's January 2nd, and here we go again. It's an interesting thing. I've been doing this 20 years. Um, and September always feels like the new year because the kids go back to school. January feels like the new year. It's the what have you done for me lately? What happened last year, and where are we going? And so we mark certain dates within a single calendar year or month to determine what value is provided and where do we go. Albeit when I look back, academically as an economist, we understand that markets are cyclical, economic cycles are long, earning cycles are quarterly, and day to day things like geopolitics and even the weather can change things. But it's important that we set the table a couple times a year and say, what happened? Were we right? What were the surprises? What were the mistakes? And what were the surprises to the upside as well? And more importantly, how are we positioned going forward, and what is our views with so much information that's available to us on a day-to-day basis, whereby at best a lot of our for the formation of our opinion bases are made by headlines. So let's talk about last year. I want to reflect on 2023 a little bit. If I reread and re-listened to my January outlook last year, and the thematic was, or the tagline was, we expect the front half of the year to be very choppy, and we expect into the back half of 2023 the markets to start to discount the eventual recovery we see in 2024. I said this in last month's podcast. This has happened. It was very choppy and into the back half of the year, but boy, oh boy, the back half of the year, is in September, and September, October was terrible. I was really thinking, oh, I got the year entirely wrong. Markets had remained very challenging, so it wasn't just the front half of the year; it was the bulk of 2023. And then November and December happened, and we saw an incredible rally, which really made the year, really solidifying and giving merit and weight to some of the age old principles of staying invested during periods of volatility. We really benefited from our process and our strategy into the back half of the year. Call it on the self-promotional highlight side. Once again, MLD during the year of 2023 was named a 5-star advisory team in Canada, and I was personally once again named one of the top 50 advisors in Canada by Wealth Professional. So we continue to do a lot of things right. I talked a little bit about the November, December surprise, and everyone gives things names. The Big Four, the Magnificent Seven, Santa Claus rallies, like colloquialisms and taglines are something that at least allow us to attach market events and try to create some mean or some regression around it to make sense of it all. But just listen, 2 months ago, we made this call. The stage was set for a rally, given the extreme oversold conditions, the history of year-end rallies, especially in pre-election years. We had a lot of sour investment sentiment and a lot of catalysts that could reverse the spike in higher interest rates. I'm going to spend a lot of time talking about interest rates again. But as of that late October low, the markets were making new bear market lows. The equal weighted S&P, and I've talked about at length the equal weighted S&P versus the S&P index in itself. Now, albeit we're domiciled in Canada and we're largely Canadian investors for the majority of it, the S&P 500 in the U.S. market makes up over 50% of economic activity in the world, and so it's something that we have to bellwether and key off of. But while that equal weighted S&P was testing, October 2022 lows, we talked about a very narrow market return. 8 of the 11 S&P 500 sectors were down for the year. That would have been 2 times in history where the S&P would have been negative 2 years in a row. Now we had this Magnificent Seven effect where a handful of companies with very narrow exposure across all sectors, drag the entire index, up much higher. So here we go, November, December. We've seen some improved breadth. and it was process that got us through it. It's hard to do the hard thing, but process is important, and we ended the year in line with our expectations during a very challenging economic cycle. The narrow breadth of the market, as discussed, was really hodled by the Magnificent Seven, skewing a lot of perceptions. Who would have thought? Going back even to 2022. 2022, the best thing an investor could have owned was cash. 2023, surprisingly, and I'm not going to give this a lot of airtime, the best performing asset class in itself was cryptocurrency. So we go from on one side of it, cash was the only thing that worked, to the best performing thing last year was Bitcoin. But listen, here we are today. It's January 2nd. Where does the market sit today? Listen, the S&P is overbought. Volatility is absolutely poised to bounce in the front part of the year. We've got some economic data coming out as early as Friday that will really set some tones. So we had this huge surge that really surprised everybody through November and December. Investor sentiment is giddy. Surveys of managers across and investors across the board, it's at near all-time highs. So, and all that has been on less bad news. So the Fed has pivoted and become more dovish. They have said that the hiking cycle is over. People have been talking into the back half of the year that it was higher for longer, and get ready for high interest rates for much, much longer. And that's what kind of really delayed things. But that's changed, and all of a sudden the markets has surged off of that. So remember, markets surging off of just less bad news, is one thing, but where's the sustainability in that? So we've seen rate cut expectations pulled very forward and discounted heavily. The market is now forecasted and discounted the Fed to cut rates 7 times this year, down to about 3.5. The 10-year U.S. Treasury bond yield is extremely oversold. So this surge in breadth of the market, and that's something we're seeing more companies doing better, not just these big 7 companies, Nvidia, Facebook, Tesla, etc. So that suggests not betting against the upside in the intermediate term, while the extent of gains and the tactical setup, suggests don't chase them in the near term. So, if you're long, you're long. I wouldn't bet against it. Betting against it means going short. I would not short the U.S. market, but I would also tripping over ourselves. We're not trying to be overly blindly optimistic. So in short, we don't need to figure out where the rest of the year is right now. We just need to see how the market responds to the current setup. Listen, looking ahead into 2024, the financial landscape, as always, it creates both opportunities and presents challenges. Our focus remains on navigating these with a strategic approach. We observe trends in the S&P and the global markets that continue to suggest caution optimism. It looks like we're now going to avoid a full recession into the U.S. Earnings yields and the U.S. 10-year spread, for instance, have shown some interesting dynamics that we're closely monitoring. While, yes, there's the possibility the S&P might be slightly overvalued, historical patterns also indicate opportunities for positive returns. We believe in sticking with our process, albeit improvements and adjustments to align with current market conditions. So that's, call it, a lot of pre-disclaimer and a lot of mantra around overall topics. But, I'm sitting here saying, what are the areas we're closely watching? Things that are, occupying a lot of space and time and headlines in my mind and our teams is, interest rates. Do we see this? Does the Fed come through and become more dovish? They've signaled they are, but farm payroll, non-payroll data could come out this Friday and cool that. Real estate, both cross-border, what's going to happen in Canadian housing versus that of kind of U.S. housing. I've said this many times over. The U.S. consumer is in far better shape than the Canadian consumer, yet we've seen headlines already start to make realtors happy again, expecting that house prices take off to the top right again. At its core, our immigration policy in Canada, with net near wide open borders, will continue to put upwards pressure on single family homes across the board. Luxury markets, we've already seen starting to, outside of, call it, our core demographic, have really started to correct. Technology versus equal weight, I will tell you, it is highly unlikely. Again, highly unlikely is we're weighting probabilities. What are the odds, or what weighting would we give to any certain outcome? Because at the end of the day, up or down is just merely a 50-50. When we're looking where things are going to perform well or perform poorly, we have to assign a probability to them. If we have high degree of confidence, there's an 80% chance that something goes up. We're going to weight that accordingly. So at all times, I do believe it won't. Or not, this time being different, we don't expect that the Magnificent Seven to perform like they did last year, upwards of, Nvidia and stocks like that being up over 200% in 1 year. It's not going to be those same seven stocks. So looking for more value across the chain, looking for, deep value where just natural fund flows. Just remember, money market funds were the largest recipient of fund flows last year. As those buckets start to turn, as we start to see rates come down, that money, that risk-free rate of return, will start to look for a different rate of return and come back into the equity markets. Things that we have to be cognizant is global conflict. We at least thank God I don't have to talk about COVID anymore. But we saw Russia, Ukraine. We've seen Israel and toiled in conflict and tragedy. And potentially this year we have a China-Taiwan situation. So this deglobalization is real. You have a multipolar world and keen political regimes globally that look to take power where they can. And we have a U.S. election year coming up. So that's going to be very telling. We played it incredibly well 2 economic cycles ago. We'll see what happens this year. One of the things we thought going into last year was largely that both parties would probably have 2 new faces to them going into this election. It does not look like the case. It looks like it is going to be 100% Biden versus Trump one more time. And here we go into that circus. So listen, in terms of strategy for 2024, we do see value in large cap stocks. We continue to see positive tailwinds and a boon for private credit. I'm going to talk a little bit about gold. I'm going to talk a little bit about copper. Energy is a thematic, and energy is more than oil and gas, and we'll touch on that. Healthcare and AI. And the optionality that we see as a potential for a risk on market where capital markets could open the floodgate with a ton of pent up demand for IPOs, which have been at historical lows over the last 2 years. So, let's talk about gold. Listen, there was, there's a portfolio manager. I can't remember who it is. And maybe it definitely wasn't Warren Buffett, but there was a phrase saying, there's only 2 people I buy gold for, my wife and my girlfriend. Now that's incredibly uncouth, but for a long time, I could never really wrap my head around, what it is. Is it a store of value? Is there industrial use? Now, listen, aside from very expensive speaker tips and some conductivity things, largely gold is a safe haven, a store of value. And the digitization of tokenization of cryptocurrencies and blockchain technologies have taken some of that luster away. But the idea of fiat currencies only being backed by central banks and uncertainties in the world, gold's not going anywhere. We're seeing gold prices well over $2,000 an ounce, but equity prices have not adjusted. Kind of reminds me when we had $30 oil. There's value in these large cap, dividend producing, clean balance sheet gold names, and I think the market is going to look at value. A recent statistic I saw: gold miners as a whole, EV to EBITDA trade around 9 times, whereas the S&P's significantly higher. So gold's large cap gold stocks are about 2/3 as expensive. Dividend yield on large cap gold stocks is 35% higher. Net debt to EBITDA is fractions to that of the overall market. These things have very good balance sheets, and total debt to total assets. Gold stocks are incredibly less levered. And so we're starting to see, I have kind of turned up the exposure to large cap gold across portfolios. I made a big call on copper last year, not a big call by, going all in, but, a thematic. We're early for sure. In fact, during the year, I turned down the exposure. I'm not ready to turn it up, but it is an overweight across kind of our thematics of what we see playing out. I, I, I can talk to a few things in and around kind of the gold schematic of what we see, but the decarbonization, the increase of EVs, and copper being a GDP growth driver. So there's only, I think, the world has only slowed down. Has slowed down as much as it can, and we are staring into a reacceleration cycle through the other side of the last 2 years. Um, Copper mines across the world are only in more geographically sensitive areas, whether it be ESG concerns, whether it be geopolitical concerns. Grades are lower. There's a long lead time into bringing on new copper production, and not even year over year, but month over month, the data and that we have, and with the tightness of supply, if China housing turns back on, and kind of the 1 to 3 to 5 year picture for the need for more copper, albeit yes, 25% of the copper we use in the world is recycled, is not used, is just repurposed. There could be a scenario, I believe, over the next, I don't know if it's in the next year or the next three, but we will see a massive bull market in copper. Just remember, no one rings the bell and tells you when it starts, and it's just important that we have positioning. And some of the strategies that we've employed in and around the large cap copper producers while we wait, using covered call strategies, enhancing the income, getting paid for while we wait, is going to be important, because the thematics for, listen, copper is just more population, more economicization, more people moving out of the third world and into the second world, or in off of farms into metro centers, just requires more and more and more and more copper. And there's just less of it available in a high grade scenario. So that remains. Energy as a whole, listen, oil didn't do great last year. Oil was off year over year 9% as a commodity. But the stocks remained a little bit more resilient because of the balance sheets and the nature in which they're throwing off free cash flow. Short term, there's skepticism for sure. But if we're avoiding this recession that we're calling into the US, and the economic engine continues to fire, we're still seeing the latent effects of lack of investment into basins through the last cycle that will create additional tight supply, and there's still a lot of value and a lot of free cash flow being thrown off of this. So we remain very comfortable with exposures there. We've always had a meaningful exposure to infrastructure that's likely going to increase. I just don't know exactly when we pull the trigger. Again, we're talking above is don't bet against something. We're there, we're positioned. While we see reductions of interest rates, these businesses, largely whether they be pipelines, toll roads, airports, etc., these businesses perform very well. I've beaten the drum on private credit significantly. We have ample exposure there, and we expect, as banks continue to huddle their balance sheets, syndicates remaining smaller, and unconventional lending will remain at the forefront, and has a lot of tailwinds through this next market cycle to produce above average risk-adjusted returns. AI is going to be a thematic that we're going to be talking about over the next decade. I think into the I don't know where I'm at within my career. I've done this for 20 years. I'm still generally a young man, but I think this will be a thematic that we talk on. And someone always said, we talked about this at a kind of advisor breakaway, something we call advisor council to management. And we get together and we throw up ideas, or how are new technologies and new developments, whether they be regulatory, whether it be compliance, whether they be technology, of how they shape what I do for a living and how I provide services to you as our private clients. I don't think people thought that E-Trade was going to get rid of advice. It never did. In fact, we're seeing higher growth in the private wealth channel than we've ever have. Advice is what we pay for. Executing and being able to transact in the marketplace is easy, but advice is inherently priceless. With respect to AI, no, it is unlikely that I am replaced by AI, but I will tell you I will be replaced by someone else who's not, if I don't use AI. We're employing AI now across different processes of our business, whether it's, helping in content creation, helping in process management, helping to improve efficiencies of, the internal plumbings of how we sort and organize our data, et cetera. AI. So yes, Chat GPT is there. It's not the one and only thing. Yes, the companies like Nvidia have done very well because everything seemingly needs a bazillion more chips and processing speed. But the integration of AI into other businesses to create enhanced efficiencies, enhanced productivity, and enhanced profits will continue to be a driving thematic across all industries. And people that use it more and better will win. Healthcare, longevity, weight loss. It's going to be a very interesting thematic this year and on going forward. I guess 2023 was the year of Ozempic. Seemingly everyone got skinny. Forecasting data, I read something, so don't quote me on the exact. I think they said some upwards of 10 million Americans used some of the semaglutides and products that are being brought to the market. Largely were off label, but now we're getting more and more medical uptake across the community, helping with an obesity crisis that we have in North America and globally. So they expect, I think it was something like 10 million Americans last year, and they expect that number to swell to upwards over the next market cycle to 100 million Americans being using some form of semaglutides and medical compounds to combat obesity. That will fall down into the earnings of these companies. We saw it with Pfizer and Moderna through the COVID phenomenon. So we're watching closely the idea of healthcare, the idea of longevity. People do want to live forever. Staring into the mirror and accepting our mortality is one of the biggest challenges I've ever seen people go through. I've had the gift and the curse sometimes of living 300 lifetimes of private clients that are very close to us on a day-by-day basis. So we deal with some of the horrible things that are natural occurrences in life. We deal with death, disasters, and divorces. And it's just things that we work through. But staring through into kind of later chapters of our lives, people do and will spend money on the pursuit of living higher quality of lives and living longer. And so that will, and that dovetails also into fertility. We're seeing a lot of interesting things happen there. And the other one I wanted to talk about is products and services. Go back, not even a market cycle, but call it pre the market meltdown, everything was SaaS, software as a service. No one really knew what it meant, but it was, no one had to make a product, but people were going to buy it on a monthly basis or a yearly subscription. And that would create this phenomenal recurring revenue with very little capital exposure, where we could then discount it, into the future with low interest rates and become tech billionaires overnight. I look at the idea of products with services, and we look at some of the competitive moats and some of the really amazing companies that have been created. I want to talk about Apple and Amazon for a second. Apple makes phones, okay, or they make AirPods, and they make laptops, and etc. Those are products, and yes, they drive an incredible amount of revenue and profitability for these. But why they're excellent? They were able to create unique products. And listen, everyone has cell phones. There's many kinds, and yes, I know some millennial will call in and say Google has more market share, like for sure. But what I want to talk about is that brilliant marriage between a product and a recurring service, and that I think has been something that will continue to dominate. Look at the Fitbit, look at the Oura Ring, look at all of these other products that are paired with a service that go along with them. And largely they're technology driven, they're AI driven, they're in and around advice, whether they be on health tracking, whether they be on even look at the reordering of food. Amazon in itself, look at Instacart. You order your groceries, the click and take away. People want to get their products, but they want to get the service along with them. And I think that's going to create a divergence. There'll be clear winners and clear losers. Just selling a product isn't enough. Because it'll be someone else that pairs the service with it, whether it be the delivery, the maintenance, the warranty, etc. I've talked about a lot. I was going to try to keep this somewhat, not so much light. I wanted to keep it as informative and insightful. This is going to be, off the back of these last 2 years. I'm very, very excited about 2024. I think we've got a little bit of a short term volatility pop, but we are going into an increasing money supply scenario. We are going to see lower interest rates. Anytime you see the increase in money supply, it is paired with a constructive equity market. So, we've grinded through the last little bit here in the last couple of bumpy years. This is not what the only thing we've been waiting for, but it's only getting easier from here. As always, our priority is to ensure your financial well-being and peace of mind. I'm looking forward to a prosperous 2024 filled with opportunities for growth, both monetarily and in knowledge. And so here's to a year of wealth and maintaining a balanced, healthy lifestyle. I want to thank all of you for your continued trust in MLD Wealth and wishing everybody a fantastic year ahead. As always, feel free to reach out to myself or any member of my team. We're here from you. We're here for you. And all the best to you and your families.